Imagine that you wake up one morning and see that you're owing up to $730,000 worth of debt. This is what happened with a 20-year-old named Alexander Kearns, who was trading options on a brokerage platform known as Robinhood. Sadly, he took his life after that. After his death, a note was found on his laptop which said, "How was a 20-year-old with no income almost able to get $1 million worth of leverage?" Alex had signed up with Robinhood, which is a millennial-focused brokerage app which also offers commission-free trading, and it's only based in the US. I didn't plan on making this video so quickly. I did plan to do it in the near future. However, due to recent times we're currently in with the market, many people are somehow believing they can beat it, and they're trying to do that in such a volatile time, or they're just getting into this investment space without any knowledge or due diligence, which is similar to what happened with Alex, and I'll explain further on. But before I do that, I gotta explain margin lending and options to you guys. According to CommBank, which is an Australian bank, margin lending is a type of loan that allows you to borrow money to invest by using your existing shares, managed funds, and or cash as security. It is a type of gearing which is borrowing money to invest. Like I said, this definition was found on the CommBank website, which is an Australian bank. You may be saying to yourself, "Oh, it's only America where a teen with no income can get such a high margin, almost next to $1 million." However, this isn't actually the truth of this matter, and I'll explain why just in a second. But I gotta explain options before I do that. Just before I get to options, in his final note, which was supposedly seen by Forbes, it says that he had never authorized margin lending and never thought he could get such a loss. But just so you guys can understand what really happened, I'll now be giving you an overview of what an option is. To put it simply, an option is a contract which gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specified strike price prior to or on a specified date, depending on the form of the option. Now that can seem like quite a bit of a mouthful, so I've prepared an animation for you guys to simplify this out, so I'll play that animation now. Meet Sarah. Sarah is someone who wants to sell her car, and she has one friend in mind called Jeff. Meet Jeff. Jeff requests from Sarah to give him the right, but not the obligation, to buy the car from her at $20,000 anytime during the next month. Sarah may agree to put the sale on the car on reserve or hold for a month, but asks for a 3% on the car, which is equal to $600 for reserving her car for him during that period. The person who takes the obligation himself is known as the originator, and now Sarah cannot back out of her 1-month contract. Jeff does not have to buy the car during this time frame, but he has the right to do so if he wanted to. I hope that animation cleared up the basic definitions in a way that you can understand and comprehend the basics. Now I'll be going through a call and a put option. A call option simply means that you have the right to buy shares at a predetermined price. And the put option means you have the right to sell shares at a predetermined price. So let's say, for example, when would this be valuable? So for the call option, you're buying at a predetermined price. Let's say XYZ goes up by $50. It was originally $30, but now it's $80. And if someone's bought that contract, you have the right to authorize it and say, "I'm gonna buy XYZ stock from you at $30 because you signed it," and they can't do anything about that. So in that same sort of sense, when would the put option be beneficial? That's right, the put option would be beneficial when, let's say, XYZ has fallen tremendously. Let's say you got XYZ at $80 and now it's worth $20. If someone's bought that contract, you have the right to authorize that you're going to be selling him the stocks for $80 despite the market value being $30 right now. And another key thing is the predetermined price is also known as the strike price, if you're just wondering. Specifically, what Alex was trading is referred to a bull-put spread according to Forbes, and I'll basically highlight what it is and how it works. The bull-put spread consists of two components. The first one is to sell a put option at a higher price, and the second one is to buy a put option at a lower predetermined price with the same expiry date. So let's say you got company XYZ. You sell a put option at $3 and you buy a put option at 50 cents. I don't want to get into specifics further on, but I hope you can see that you're basically buying high and you're selling low. And by buying that put option, you're sort of like minimizing the distance and essentially creating a safety net. But the whole key thing about this strategy is that it's safe. That's what I've been saying. But if it's so safe, what happened with Alex? That's the real question. According to Forbes and multiple option investors, they're saying it was Alex's fault. Alex couldn't comprehend the numbers correctly. I mean, if you're not in the option world, yeah, you would comprehend it, but if you're just, basic finance, or just anyone, seeing negative $730,000 in your brokerage account takes quite a bit of a toll. The enthusiasts were saying that it was essentially a short-time position which Alex was in, and after a couple of days when his options expired, he would automatically lost that money, that sort of number he was seeing, and at the very max, he would have lost $900 US. Is $900 US really worth a human life? Hell no. And now his parents, after finding that out, are complaining and trying to sue Robinhood because of its weird interface. They're saying that they try to gamify everything, try to lure you in at the start. And how can they make such a simple error afterwards? However, multiple option investors are saying that it's his fault only, because every option investor knows the ins and outs of this. Even the basics, they know that, okay, this is a short-term position, and they're claiming he wouldn't know other basic finance fundamental things such as the T+1, where they deduct money from your bank account later on. Essentially, this seems to be a wild confusion that took place. Forbes also found a note on Alex's computer admitting that he didn't know what he was doing. Now, it's easy to point fingers. We can see that, oh, it's Robinhood's fault for having such a bad interface for new investors. Oh, it's the parents' fault because they weren't supervising their child. Oh, it's Alex's fault because he wasn't doing his own due diligence. But I believe the real enemy here is this get-rich-quick fad that has been going around. Many people, especially millennials or younger generations, believe they can make money without doing much. There's two ways to build wealth, really. You gotta either really work hard or you gotta wait. It takes time or a lot of hard work, or a combination of both in most cases. But they see movies like The Wolf of Wall Street, they look at the stock market being volatile, they're like, yep, I can pin it, because they see one guy who's done that. But beating the market has always been hard. This is why many people go for index funds or ETFs rather than managed funds. But even doing that, especially in such a volatile time, there's not many people that can do that. And it's quite risky. The strategy he went with isn't that risky, but he couldn't comprehend the basics. If he could comprehend the basic numbers, he would understand, oh, I'm not in debt at all. It's just the way that the interface is designed. I hope people around his age demographic can truly understand and learn from this incident. I hope this doesn't happen in the future, because I can't understand what his parents must be going through to know that their son didn't even have to go all this for their sake, because it was just a simple issue. Now we'll see what happens with Robinhood and their parents' case. Otherwise, that's really it. But I can't imagine how any of us would wake up one morning to see negative $730,000 in their brokerage firm. It would, I don't know what any of us would do. Prayers out for his family. I hope you guys of the younger demographics learn that investing can be risky, and I hope you take caution. I'll have to wrap this up. Thank you. Thanks for watching.